Welcome to All About Money on HKIBC. I'm Chloe Fong. Earlier this week, the U.S. Federal Reserve has voted unanimously to raise interest rate by 1/4 percentage point. The decision came against a stunning global banking rout, with the collapse of Silicon Valley Bank and Credit Suisse sending the markets into a tailspin. After government intervention, the markets seemed to have stabilized, but is crisis really over? Joining us tonight is Daniel So, the Executive Director at CMB International, and we'll talk more about the latest banking rout. So, Daniel, welcome to the show. And this Thursday, the U.S. Federal Reserve has again raised its interest rate by 1/4 percentage point to the now 4.75% to 5% this range. And this move also came against many calls, urging the authorities to take a pause or, to reflect what's going on here before making further rate hikes moves. But then the move came anyway. How would you interpret the fast move, and how would you comment this move? Is it in line with your expectation?
Yes, it is. And this move, a 1/4 point increase, is I think is the best decision compared to 1/2 percentage point increase or a pause. Because just 2 weeks ago, the Federal Reserve Chair Powell hinted that they may consider speed up the pace this time to about 1/2 percentage point of increase. But if in this case they chose to pause, then it may give a bad signal to the markets that is there any potential banking crisis, further crisis that the public haven't seen, but the Federal Reserve is aware. If they choose to pause now, then it may actually trigger panic selling in risky markets. But on the other hand, if they insist on a 1/2 percentage point increase, then they may overshoot on the interest rate hike, and it may drive the U.S. economy into a recession fairly quickly, or in the short term, there would be further financial market shock.
So far, because the move is not, the task is not done yet, because we still have the high inflation, and now so far it's at 6%, so we still have a long way to go before it reach its targets of around 2%. But then the 2023 dot plot, meanwhile, remain unchanged and predicting a year-end peak at around 5.1% before falling to 4.1% next year. Earlier, there were also some voices saying, there may be some rate cuts at the end of the year. Do you think it's possible?
It is possible, but Powell stressed that they are not considering a rate cut in the base case. But there are huge uncertainties going forward. How much impact on the economy from the current banking crisis, we don't know, and maybe the Fed doesn't know as well. They may have to monitor the upcoming data and the development in the banking sector or the general financial market overall. So there is a possibility they may actually cut rates, but Powell stressed for a few times that it's not the base case. I think towards the end of the year, there is really some possibility, maybe over 50% that they may cut rates, because in our forecast, the U.S. economy will go into a recession, maybe a mild one, not really financial crisis mode, but given a mild recession, then given the current high level of interest rates, there are rooms for some rate cuts towards the end of the year just to support the economy. And there are huge uncertainties, of course, but I think in my base case, the Fed will cut rates towards the end of the year.
How would you interpret what's happening so far? Compared with the 2008 financial crisis, do you think this is something that will be, at a similar level back then, if more risks are going to be reviewed later on?
This time there is a big difference. The central banks or the governments are very quick to act compared to the year 2008. The Lehman Brothers crisis, I think all the central bankers or government officials have learned from that. They have to act very quickly. We have seen from the Silicon Valley Bank and the Credit Suisse events, the central banks are quick to step in to prevent the crisis to go further. I think this time, if necessary, they will act very soon as well. And Powell also stressed that in the very beginning of the post-meeting press conference, that he's trying to give confidence to the public, to the investors, that the Fed will step in if necessary. But now he thinks that the U.S. banking system is stable and healthy.
So he thinks that authorities are hinting that this crisis seems to be managed, like under control. But do you think it is the case now, or do you think there will be more? We will see a similar circle happen again in the short term, for example.
I think there would be more events like the Silicon Valley Bank or Signature Bank. These kind of more mid-sized or smaller-sized banks, there could be more crisis or more banks like this that need to be bailed out by the government or need to be acquired. But for very large-scale banks like a systematic important banks like
Credit Suisse,
yeah, I don't think there are high chance that another one would need to be bailed out or acquired. But I think would there be more banks like the SVB, which in Powell's word, they have bad management, they have exposed themselves to long duration risk. There's such a mismatch in their risk, which would cause some failures or some more bank runs. It is possible, but if this is such crisis in similar scale, then it is under control. The central banks can manage.
One thing is also, like you pointed, is the authorities also acted very swiftly to, make it under control as well, which is very impressive in a way. And also speaking of Hong Kong markets, so far, how would you interpret the Hang Seng, for example, Hang Seng Index performance so far? Is so far reacted okay-ish? Would you say that?
Yeah, it's okay because it's more indirect, the impacts from the US and European bank crisis on the Hong Kong market is the first one. In Hong Kong, the banks shares like HSBC and Standard Chartered, they have come down during the past 2 weeks since the crisis unfolded. But overall, the market has been quite calm reacting to these events because there are more supporting factors for the Hong Kong and China markets. The economic cycle are different. The US is heading into a recession or at least a soft landing in the best scenario, but China is coming up from the pandemic lows. The economy is recovering and the inflations in China are mild.
Under control.
Yeah, giving room for the PBOC to do more easing. Not very aggressive easing, but maybe a further cut in triple R rate or some possibility of cutting interest rates as well. So for the banking sector in China and Hong Kong, overall is more healthy. And the financial markets in Hong Kong, the stock markets have come down over the past 2 months. And one of the main reasons was the fear of speed up in Fed rate increases. But now these fears have moderated a lot. So the Hong Kong market has already factored in many risks, but now the Fed, a more dovish Fed, would lend some support for the Hong Kong market.
So do you think like the volatility could be, be more mild later on, isn't it?
Volatility may remain at similar levels. In fact, in the past 2 weeks, the Hong Kong markets have come down, but in an orderly manner. Volatility has not been huge compared to last year. Going forward, there would be bumpy trading sessions, but I think most of the correction phase has been over. At current level, Hong Kong markets should find some support.
What is also your forecast for the Hang Seng Index performance for this year, let's say, in 1 year's time?
The upside is from here is about 20%, I believe. The target is around 23,000 to 24,000.
That's a still huge room to go then.
Yeah, some room. I think it's compared to the US market, the Hang Seng Index would outperform this year, especially in the upcoming 1 or 2 quarters. As I've said, difference in the economic cycle in the US and China. It would be one of the main factors, and also different dynamics in the monetary policies, more easing, more supportive policies from China, and the valuation is also quite different, given that the Hong Kong market has underperformed for many years, especially the previous 2 years compared to the US. So the valuation is still attractive in Hong Kong. There would be some more room for revaluation.
And speaking of the latest, for example, the collapse of Credit Suisse, one of the controversial issues is like the authorities has decided to completely write down the Coco bonds or the so-called additional Tier 1 bonds, and it also sent a shock wave across such bond markets. How would you comment on authorities' decision this time, to completely write off the Coco bonds? Because there's a hierarchy that equity holders should be the first ones to hit before the Coco bonds holders to be hit, isn't it?
Yeah, it's definitely controversial. The decision by the Swiss central bank is quite different from the European Central Bank. After the Credit Suisse acquisition announcement, the ECB, European Central Bank, announced on Twitter that the hierarchy should be, if you said, different. It should be the bond first and then the equity in the claim sequence. So it is a controversial decision by the Swiss government or the UBS, Credit Suisse. I think it is a rash decision maybe, given the limited time for the central banks and the two banks to make this acquisition decision. The UBS may be unwilling to bear a lot of losses, so therefore there is this decision to write off the Coco bonds value. But I think there is still some uncertainty ahead whether the Coco bond holders can claim some value from it.
Because I know that, for example, the Goldman Sachs, they're saying they are ready to start trading claims, to recover some of the losses, isn't it? Do you think there are chances to get it back?
Yeah, there are some chances. Of course, they cannot be too optimistic. Even they can recover some values. That may not be much, but at least they may be not zero. So there are some chances that they may recover some losses, but it may also take time. Some legal issues will take a long time.
All right, hold that thought, Daniel. We'll take a short break for now, but coming up next, we'll have more discussions over the recent banking crisis, so stay with us. Welcome back to All About Money on HKIBC. I'm Chloe Fong. Still with us today is Mr. Daniel Su, the Executive Director at CMB International, and we're talking about the recent global banking crisis, as well as what does it mean for the post-COVID financing industry. So thank you so much, Daniel, for joining us tonight. And earlier we have touched on the Coco bonds or the additional Tier 1 bonds, especially in its case in the collapse of Credit Suisse. And there are also some controversies surrounding it. And now I know that for such bonds, it seems to have limited impact in Hong Kong markets, isn't it? Because for the case in Hong Kong, it's considered as higher risk, products. Therefore, only professional investors are able to invest in it, isn't it?
Yes, I think it is one of the main reasons that it seems to have caused limited impact on the market in Hong Kong. But professional investors, some of them are just more high net worth retail investors. So there will still be some risk in that, and even for institutional investors, some of them may have fallen into this trap, if you like. So there would be still some volatility, but maybe this product is not as common compared to the European or the US market, or especially European market. In the US, it's not common actually. So I think it's the difference in prevalence in Hong Kong compared to Europe. It is not that prevalent in Hong Kong, so it hasn't really caused much stir in Hong Kong.
Right, and also, but after this issue, do you think, some people are also saying authorities are kind of like making a first, special. Do you think it's going to be a special case, or, some other authorities in other jurisdictions may also refer to what happened in the Swiss government? And do you think it will also cause negative impact in other areas as well?
I think for the general risk appetite, it would have some negative impact. I believe Coco bond is not the only one which would cause controversy. The underlying risk, investors, before they buy, maybe they are not fully aware. Their financial consultants may not have fully explained the risk. There may be some more other sophisticated products by financial engineering, maybe that would have similar risk levels. Investors would be aware of such risks. There are uncertainties. Investors, they don't like uncertainties. So if they look at their portfolio, they're holding such products or bonds which may have high risk, then they may dump the products. So in the bond markets, there would be more volatilities ahead, and flights to safety is expected. So for the top level investment grade bonds or sovereign bonds, we should expect the yields would come down due to some money inflows.
And also, speaking of the recent whole saga, it started from the Silicon Valley Bank because it's a poor management and balance sheet. How come do you think that authorities didn't see it coming?
I think the authorities mainly look at issues which may violate the regulations, but just poor management of duration risk or some mismatch in their deposit and investments may not really cause the attention of regulators. So I think the regulators are putting the blame on the management of certain banks, but it is not a systematic issue. They are not doing something illegal or against the regulations. So for the regulators, I think so far the blame are not on them. Now the case is how they can control the damage. Prevent the damage to disperse to other areas. But I don't really think investors can put the blame on regulators so far.
And also on the case of collapse of Credit Suisse, because it's kind of different from the Silicon Valley Bank. Although there are similarities, but still it's mainly because of the loss of trust, like that is triggered by the Saudi National Bank's chairman's remarks, saying that they are not increasing their support for the Credit Suisse. That triggered panic as well. After this whole issue, how could these banks regain their trust? Because without trust, the finance is going to worth nothing, isn't it?
Well, the banks have to be transparent about their holdings and investments and about their financial strength, have to be more transparent than ever. Even if they do hold some high-risk investments, which may trigger some investment loss or mark-to-market losses, they have to be transparent because investors don't like uncertainties. They would doubt if the banks are holding risky assets if they don't reveal themselves. So they have to reveal their investments, tell the investors what they are exposed to, what risk they are exposed to, and if there are really some concerns, what measures they would do, whether they would do some capital replenishment, what plans they have, so as to reassure investors.
But also, on the other hand, for some very small retail investors, it's also very hard for them to assess risks. So do you think, in a way, there will be more rules setting up, like from the authorities or regulations, in a sense, to help depositors better protect themselves?
Yes, I do think so. But I think it may need some time to draft regulations to discuss, to go into the legislation process. It may take time, but for the short term, there will be more stringent supervision from the regulators and also from the banks themselves. For example, they may be more prudent in lending, in granting some lending to protect themselves, protect their capital, preserve their capital. And the consequences is not only on the financial market, it's also on the real economy. Because banks are more prudent, there will be less money flowing into the real economy. So that would put more downward pressure on the U.S. economy or the global economy as a whole.
Right, but at the same time, some people are also arguing that now the authorities are having more interventions or support into these banks who have this kind of like poor management or poor balance sheets. Do you think, in a way, should these banks with poor management just be allowed to fail without the intervention? Do you think the intervention is a good thing, or what is your opinion on this?
Intervention are crucial when necessary. We can't say every time central banks have to intervene, but the existence of central banks are the banks of last resort. When there are systematic risks, they have to step in one way or the other. There have always been the debates on moral hazard since the year 2008, whether the regulators should save Lehman or should they save AIG or Bear Stearns, etc. There would always be such debates, but I think overall speaking, it is a good thing to intervene to prevent the systematic risk. If regulators just let such systematic important banks collapse, then we will see a repeat of the Lehman Brothers crisis, causing global depression, causing a failure in global financial system, and that's not a good thing, of course. So I think central banks have to step in, but for the banks management who badly manage their banks, they would bear some cost as well. Maybe their position would be gone. They will go jobless, whatever. It is not the case that they will have no consequence.
Right. I also would like to get your thought, like who is going to pay for this collapse or the lifeboat for them as well. But before that, I want to know about your thoughts on the China's so far. The banking sector seems to be so far under control, quite resilient, and we also mentioned a bit on the previous section. But now the authorities are also encouraging banks to lend more money for property developers to ease its housing crisis. Do you think there will be some risks emerging later on as more supportive measures being rolled out and more banks lending more money?
So far, the risks are manageable. Since the fourth quarter of last year, there have been policies supporting such lending by banks to the housing market, to the developers. There were risks, but as we have observed, many of the new lending have gone to those big developers, those SOEs, which have less credit risk, less risk of non-performing loans. So for the banks, they have been quite prudent, I think. There are lots lending lots to the most risky private developers. So I think so far the risks have been manageable. And another crucial point is the recovery in housing markets has been better than expected, judging from the prices and the new contract sales. So for the developers as a whole, the cash flows have improved, and thereby putting less risk on the bank's balance sheet.
So you think the risk is still manageable, right? Thank you very much for your thoughts, Daniel. Appreciate your time. That's Daniel So, the Executive Director at CMB International. And thank you for watching All About Money. We'll be back next Sunday night. So until the next time, please have a good night.